Welcome to the TradeRobotX weekend briefing for March 21st, 2026. We're going to break down the key macro drivers and signals that you need to be watching for the upcoming trading week. Let's get right into it. So let's be perfectly clear from the start. The single most dominant force driving markets right now is energy-driven inflation risk. This one idea frames everything else we're about to discuss. Here's how we'll walk through it. We'll define the current macro regime, trace that energy to inflation causal chain, look at the key signals across assets, then talk about navigating Monday's open, and we'll finish with the single core insight to take with you. First up, the premise. We need to define the environment we're all operating in. Understanding the market's core sensitivities is crucial because it explains why things are reacting the way they are. So what does this regime look like? Well, it's supply sensitive and it's yield dominated. That means shocks to supply, especially in energy, are the primary catalyst, and the market prices its reaction through bond yields. The condition is also liquidity fragile, meaning volatility isn't driven by some big underlying trend. No, it's event-driven, highly sensitive to every energy and geopolitical headline. And here's why that matters. In this kind of fragile setup, even small changes in energy prices can ripple through global markets with incredible speed. It becomes a chain reaction. So let's look at the engine behind all this, the energy inflation causal chain. We're going to trace exactly how one asset's move can cascade through the entire system. You'll see this isn't random noise, it's a very logical progression. This is the domino effect, step by step. First, energy prices rise. That immediately pushes inflation expectations higher. In response, bond yields have to push higher to compensate. That, in turn, strengthens the US dollar. And a stronger dollar tightens global financial conditions, which ultimately forces risk assets, like equities, to reprice lower. This chain is the engine of the market right now. Now, given that chain of events, we can identify these specific gauges on our dashboard, the key variables that tell us where we are in that sequence and what could happen next. First and foremost, you have to watch oil. It is the primary macro driver. It's functioning as the inflation trigger for the entire global financial system. Essentially, where oil goes, it sets the direction for yields, the dollar, and risk assets. Next up are bond yields. These are the control variable. Think of yields as the main mechanism for tightening or loosening financial conditions. So whether risk assets find a floor or have to fall further, that decision almost entirely depends on the behavior of yields. And this, of course, leads to the central question creating all this uncertainty. How will the Federal Reserve respond to this energy shock? Their reaction is what every trader is trying to decipher right now. And there are really two divergent paths the Fed could take. In one scenario, they see the shock as purely inflationary, which would force them to maintain a hawkish stance. But in the second scenario, they could view it as something that's growth negative, essentially a tax on consumers that will harm the economy, which might allow them to ease policy down the line. The market is currently torn between these two interpretations. Our third gauge is the US dollar. A helpful way to think of it is as the global liquidity valve. When the dollar strengthens, that valve gets tighter. It squeezes global liquidity, puts pressure on emerging markets, and it lowers the appetite for risk assets across the board. So what about when traditional markets are closed? That's where we look to crypto. It serves as a fantastic weekend sentiment indicator. Because it's a 24/7 market, it provides a real-time signal of liquidity and risk appetite. Watching Bitcoin's behavior, particularly if it's holding above that 69K level, gives you a critical heads up on sentiment going into Monday. And finally, we look at gold. Gold's price action is a fascinating tell. It reveals which force is really dominant in the market right now. Is it the upward pressure from rising bond yields, or is it the demand for geopolitical safety? Gold tells you which narrative is winning. Okay, so we have the engine and the gauges. Let's put it all together into a practical framework for navigating Monday's open and the week ahead. We can map out three pretty high probability scenarios. If oil stabilizes and yields are flat, a relief bounce is definitely possible. If oil and yields both continue to rise, you should expect continued risk-off pressure. And of course, if there's any major geopolitical escalation over the weekend, you need to prepare for gap-driven volatility right at the open. So your checklist for Monday is simple. These are the 4 signals to watch in real time. The price of oil, is it stable or is it rising? The direction of the 10-year Treasury yield. The US dollar, is it showing strength or weakness? And finally, the behavior of Bitcoin over the weekend. These 4 variables are going to set the tone. Okay, let's bring all of this together into one core insight. This is the single most important takeaway from this entire briefing. Let's distill it down. First, markets are trading energy-linked inflation risk. They are not trading growth expectations. Second, as long as oil remains elevated, expect cross-asset volatility to also remain high. Third, understanding that energy to inflation to yields chain is absolutely essential. And finally, remember that the entire system is going to remain fragile until oil finds some stability. Which leads us to this final thought. The day-to-day price moves might look chaotic, but they are not random. They are still flowing through the same logical, causal chain that we've outlined here. To stay on top of these dynamics, subscribe for our daily macro briefings and get real-time cross-asset intelligence from TradeRobotX. Thank you for your time.